Ladies and gentlemen, good afternoon, and thank you for taking the time to be with us today. My name is Hegriv Khaitan, and I'm a partner in Khaitan's M&A practice group. On behalf of the firm, I'd like to extend a very warm welcome for this webinar to each one of you, whether you're in India or abroad. This is the first webinar in our M&A series in 2022, and we look forward to your company throughout the entire series. We have an excellent program this year based on the feedback we received from the participants in last year's series. We've really been thrilled with the tremendous response to this year's M&A Master Series, with literally thousands of registrations for webinars across the series. We are very grateful for the interest and support of our clients, associates, and others that have shown for this webinar. Today, for this webinar, we are looking at private equity from an M&A perspective. On this slide, you can see the agenda for today's webinar. In short, it will be a panel discussion with our experts, with a Q&A session with the audience after the panel discussion. We have already received several audience questions, and if you have any questions, you can submit them using the box provided in the webinar portal. If we cannot cover all questions, we will answer them later and respond offline. Please also note that after the webinar, you will receive a copy of the presentation, summary notes, key issues discussed, and a link to the webinar recording. Today, we will discuss key issues for private equity in Indian M&A. Private equity is a major force in Indian M&A, and so understanding private equity perspective is very important to develop a good understanding of the M&A market dynamics and conditions in India. This webinar is very timely as private equity investment in India spiked in 2021, and whether the momentum will be maintained in 2022 is one of the key issues which we will explore today. Every person who has registered for this webinar today has already received an email with full particulars of the credentials of our panel. So I'll not spend time repeating or summarizing their experience. Suffice to say that all are private equity experts with excellent credentials. We are fortunate to have with us three leading private equity practitioners on our panel today. Gaurav Deepak is the co-founder and CEO of Avendus Capital. Among other things, Gaurav has a keen interest in the impact of digital innovation on society and value creation. Pankaj Patwari is the Managing Director at Advent International. Vibhor Talreja is the Managing Director with Evanstone Capital. In addition, we are joined by my fellow partners, Karthik Maheshwari and Vineet Singhal, who are very well experienced M&A and private equity lawyers. This is really indeed a very well diversified panel where you have a banker, you have investors and lawyers in the PE world. So now let's bring in our expert panel members. So Gaurav, if I may start with you on market outlook, or maybe Pankaj, you could take that with our market outlook. A recent survey, that is the Global M&A Deal Makers report, suggests that for financial sponsors, Asia, excluding Japan and China, is the most popular destination for M&A deals in 2022. Do you believe Asia is increasingly important from a PE perspective? And what does that mean for India?
So I agree, as you rightly said, right? I think not just Asia, but I would say India also is increasingly becoming important within the whole overall Asia piece. Now, if you just looked at a few facts, deal flow has increased almost by 60% for Asia over the last 5 years. It's backed by huge fundraisers. Some of our peers have actually tripled their fund size versus the last fundraise and have now raised funds in high single digit or low double digit, right, in terms of billions of dollars, which actually leads to a lot of dry powder available to them for Asia. And if you just looked at the amount of dry powder which is available, it's equivalent to almost 3 to 4 years of capital flow, which has happened in Asia from a private equity perspective. So deal flow is expected to be strong. I think within that, India is increasingly becoming important for three reasons in my head. A, there is expected to be an economic rebound. B, India's export stories, if anything, is going to become more stronger, driven by some of these trends like China plus one. And C, lastly, I would say, even from a regulatory perspective, investors are now seeing India as a more stable regulatory environment versus other countries like China, right, where there's some nervousness around the whole regulatory landscape. So I think a combination of all these three things should benefit India also over the next few years from a capital flow perspective.
Oh,
Let
that's
me
really hard to note. Yes, Carl, sorry, you were coming in.
add. So I think this is a market that Avendas and I have looked at for 20 years, the private equity market, and I can definitely tell you that the amount of momentum we see in the market today um, is unprecedented, both on amount of supply of capital, but also on terms of absorption of capital. I think supply of capital will keep getting created and keep getting transferred across the world and reshuffled based on regulatory barriers and opportunities. Capital is flexible. In our mind, what has happened is that if you look at the three buckets of capital, which is maybe internal generation / strategic capital, public markets, and private capital, that's the three buckets of capital. Given the amount of growth rates that we are seeing, that are opportunities on what Pankaj said, the internal generation, it is a huge amount of capital for growth as well as for shift. So we are seeing a lot of volatility in the markets across the board, whether it's industrials, whether it's digital, we all know, whether we're seeing IT, etc. And the traditional way of conducting business is just not working. A lot of families are not able to adapt to the new ways of working. And private capital is practically the only way for them, private and strategic. And if you look at it, private capital to strategic capital is actually probably ratio from buyouts is almost, in our view, 5:1, maybe more. So private capital is actually doing the job what strategic capital used to do, because it's more flexible than strategic capital. And the shift of behavior of families or groups is actually creating opportunities for this capital to play in. And that is what is happening in a massive way. We have never seen so many divestments happening that we've seen happen last year or year before and will happen. And that's actually, you will keep seeing more and more. So that's, I think, how absorption of capital is going to happen in a massive way over the next 5 years.
That's really exciting and heartening to note, and very good for all of us as M&A practitioners, I should say. So, delving deeper into the subject of market outlook, Gaurav, continuing with what you said, what is the outlook for PE investment, do you think, this year? And do you think the momentum in the tech sector will continue?
Let me take tech first. I think that's a question in everybody's mind. Every friend I speak to, the first question is what is going to happen to tech. I would say let's separate that question into two parts: valuations and capital flow. I think our sense is it will take about 3 months for the market to stabilize, where the buyer and seller pricing equation comes to again in equilibrium. I would say, and we were just doing a budgeting exercise for next year and seeing what's happening bottom up with respect to all our clients. So one is, I think it will take about 3 months, and it is again going to be very, very strong flow in tech over the next, I would say, June onwards. And so I think that's one. We just need stability on between buyer and seller, some equilibrium being created, which I think is take 3 months. So that's part one. Second is that the car park, which we call, the number of companies that got created over the last 5 years which are actually changing how we buy, how we live our life, etc., is actually a very large car park just beyond the top 20 and 15 companies we all know about. So you will see a lot of depth getting created and deals getting created in the 500 million value to $1 billion value or so. So a lot of capital will get created there on the private side over the next, and clearly the seed round and the angel round and the the Series A and Series B will continue at a very fast velocity. The amount of capital that has been raised and the number of entrepreneurs that are coming in, we are seeing a phenomenal quality of entrepreneurs coming in. So entrepreneurs, absorption by market of products and services, and capital will again change where there are opportunities and entrepreneurs. So that base is actually, if you look at the data of Series A and Series B, is very heartening of new companies getting created, and that actually feeds into what you call a Series C, Series D, or a late. So we think that in 3 months you will see a very significant flow start happening again on tech. You will see public markets being a bit wary and private capital taking over both for primary deals and secondary deals. A lot of secondary deals in the larger companies, a lot of primary deals in the $500 million to $1 billion range. So that's our view on tech. Valuations, coming to valuations, I think valuations need to stabilize. They've been actually overheated. We have maintained that for a while. But the other thing that I'll tell you is we are now tracking many companies on a monthly basis, and the earnings are growing very fast, or the revenues are growing very fast. So these guys will lean into their earnings and valuations pretty quickly. So while valuation will not grow, but the multiples will reduce practically a bit. But this is fine, because that's how the growth should happen. So I think that's on the tech. Overall outlook, as I just said before, just take healthcare. Healthcare, we saw almost triple the amount of private equity last year between delivery and pharma as compared to the previous year, or 2.5 times. So which is a very strong number. And if you look at private equity, you will see a lot of secondary private equity deals, which actually got invested about 5 years back, 4 years back, because public markets will be a bit tepid in our view. So you will see a much higher amount of private equity this year as compared to last year. One of the areas we didn't see too much private equity last year was financial services, for instance. Okay, you will see financial services actually playing in. Financial services is a large part of the portfolio for most private equity guys, and that will also start coming. So I think overall our view is that the momentum will continue, and actually it will be a far larger capital deployed this year as compared to last year.
Thank you. Very astute thoughts, and I get reminded of several years ago when I asked Gaurav about tech, and he told me that if you're not in tech in every way, whether you're a lawyer, investor, banker, in any way, then you're out of business. And I think 3 or 4 years since then, we can really see how the market is transformed and how true. So great listening to this ever optimistic tech banker Gaurav, and he's actually shown the way of what he's been saying for a long time. So over to you, Vibhor. Let's talk on another subject. And when we say the market is very hot, we talk about a robust market ahead. Let's talk a little bit about competition. We see so many private equity players today investing in India, and a huge amount of money flowing in. Who do you see as your major competitors when doing deals?
Sure. Good afternoon, everyone. Thanks, Haigreve. Competition has no doubt increased. India is a competitive market. Having said that, we should all realize, as Gaurav was alluding to, that the market has become much, much larger. I think if we look at the last 5 years average private equity investment value of the market, it should be close to over 2x of the 5 years before. Last year itself, the private equity investment in 2021 crossed $60 billion, which would be more than the total of 5 years at the start of this decade. So the market has become much bigger, but yes, there are today a lot more players. Having said that, if I look at my past experience, I would still believe that the total number of funds to deals in India is a lot lower than in US and probably than in China. So what I'm trying to say is that while the market is increasingly become competitive, India market might still be less competitive from a private equity perspective than definitely than United States, where typically when we used to bid, we used to compete with a number of peers in teens. It always used to be either 13 or 19. China was not a very different story. India is still getting there, probably. So we have to deal with this competition. I think in terms of exact peers we compete with, the new perspective that we have developed is that often the competition is coming from unexpected quarters. There is still money coming in from investors that are not based in India, and that sometimes comes as a surprise. People have attempted doing buyouts without a significant presence in India. While less than ideal, there are pockets of capital which are opportunistic, and sometimes people would like to put the cart before the horse and then set the processes. So that is some of the things that we have seen. But on an overall, it has been the size of the market has been very supportive in terms of doing what you want to do, despite the increasing competition.
Very, very interesting thoughts, Vibhor, and very interesting to see how the market and the size is growing, and sort of this mixed feeling. In the one hand, competition is increasing. On the other hand, it's not yet as intensive as perhaps the West. Very interesting. So let's move to another topic, investment strategy. And Pankaj, over to you. How is private equity strategy regarding investment in India shaping, you think, in 2022? More in terms of deal size, control deals, co-investment deals, and maybe other investment characteristics.
Yeah, so there are really, I think, four mega themes there, Hargreaves. The first one, I think Gaurav is the expert to talk about, right? Tech. I think that's a piece which I think a horizontal, which is cutting across verticals. And even traditional, even large bulge bracket private equity funds are realizing that across verticals, you'll have to form a view on it and find a way to play it. So I think that piece is going to increasingly become important, not only for classical investors who are seen as tech investors, but even for a whole bunch of other investors who now see it as a sizable piece of the market, right? And therefore cannot be ignored. I think the second piece, which is increasingly becoming important, the second theme is buyout. And I remember 10 years back, when I was a young associate without gray hair, we used to look at the stack bar of deals, right? And control deals used to be a very small portion. And we used to go back and say, hey guys, it's a large minority market. If you look at the stack today, it's fully reversed. So control and buyout deals have become an increasingly large portion of the market, driven by two, right? The first is what Gaurav mentioned in the right at the beginning, the supply side. More and more founders are realizing that either they have succession issues or they can't deal with the changes, right? And therefore are willing to part with control or significant portion of their stake. The second is even private equity comfort on being able to deal with control situations and execute management changes, right? So most folks today have a bench of management team, operating advisors, internal operational teams, right? They've replicated the global toolkit and are getting more and more comfortable to do control deals. And you see more players going down that path. So I think that's the second theme, which is we see playing out. The third piece is just folks are getting more creative, as Vibhor mentioned, right? The market is more competitive. So people are getting more creative in the kind of deals they'll do. Carve-outs, right? For example, both Vibhor and myself have seen the whole Crompton example, right? We carved out that business. Eureka Forbes, which we recently bought from the Shapoorji family. So carve-outs and even probably platform deals. Folks are taking a buy and build approach and saying, we'll create a scale business out of a fragmented industry. And we've done in a whole bunch of our situations. We've played that game, right? So I think that's the third theme which we're seeing play out. Lastly, I think from a deal size perspective, the market itself has shifted. And that's, again, if you look at 10 years back versus now, you find a lot more opportunity to deploy larger checks. And at least we see a lot of our peers also gravitating to more larger check sizes.
Yeah. You're very insightful, Pankaj. I mean, is it really that other than tech, the minority investment market is sort of drying up a little bit. Is that the feeling you're getting?
No, I wouldn't say that. I would say it's just that there are more opportunities to do control, right? Not just tech, right? Look at financial services. You do have a whole bunch of minority situations coming there. So I don't think the opportunity set is drying up. The market itself is expanding high grief. And within that, it just happens that control tends to be a bigger portion. But I think both tend to be relevant plays.
Yeah, probably a fair way to look at it, like Pankaj was trying to allude, is that the control opportunities from almost extremely difficult and very low percentage of the market in 15 years back and 10 years back has now become a reasonable proportion of the market. So at least one does not need to convince one's ICs about the market not being existent. The other thing I have seen on the strategy is that given now with the Indian market becoming larger, a lot of funds have started customizing their strategies towards the Indian market, which earlier used to be very difficult because it was such a small market. And for the larger funds to try and customize their strategy towards a small Indian market, of which there will be a small single-digit market share, seldom made sense. But now, given individual sizes of the markets, like just the tech investing piece has become so large, the minority FS is reasonably large, that a lot of funds which are either sector focused or when they are trying to establish a beachhead into India, they are coming with a more focused sector strategy to start their play. And that is again a result of the larger size of the market.
And there's another theme, which is while it's not a large portion, you're seeing private equity sort of increasingly start thinking like strategics, right? So you have a company and then you kind of use that as a strategic base to go and acquire more. And we're seeing a lot of our peers also do that.
Amazing to see how quickly and rapidly market dynamics have changed. And I remember when I did my first major PE deal on the control side, there was just so much nervousness of whether a control deal will work or not, whether PE in India will be able to have the management to be able to do a control deal and then also do a secondary out of a control deal. And today, I think that's become the norm rather than the exception in some way. Very interesting. So, Gaurav, coming back to you, you had this underlying message on valuation, which you seeded when you were talking about the market. So maybe it's a good time to discuss. Can you tell us a little bit about the impact of COVID on PE valuations for M&A? And what is your outlook on valuations generally for 2022? For some reason, we can't hear you, Gaurav.
Can you hear me now?
Yes, we can hear you.
So I said, let me start with the outlook first. And again, what we will see is we will see a differential of companies getting deals done. So funds on the private equity side and even strategics will take a very judicious call on who is able to solve for the disruption that has been created by COVID and who's got disrupted due to COVID. And I think that is the chasm that is getting crossed right now. There's a lot of, and that's why financial services was, and I alluded to before, because people were still figuring out which balance sheets and which books are getting more certain, which are not, and which business. Digital has significantly grown as a percentage of overall business consumption of a household as compared to pre-COVID, whether it's entertainment, whether it's education, whether it's other businesses. So I would say that I think that's the first port of call. COVID is in terms of digital versus other issues with COVID. You will see a lot of pharma businesses growing up very differently. As far as relative multiple valuations are concerned, I don't think they're coming down. I would say once you kind of sift through the companies or which are the companies you want to back, my personal sense is given the amount of consumption that you're going to see in India, and the point that Pankaj mentioned around exports, both IT as well as manufacturing, you're going to see significant growth. So once you have a good growth model, and I'm very bullish on export growth across the board, all kinds of manufacturing and technology services. We don't think, actually we think valuations, so also we'll take a cue from the public markets. Clearly, sort of the marketplace defines the value to a certain level. So I think what you see in the public markets will reflect in the private markets. That's what I would say. So I think it's less about valuations, is more about who will get funded or not. But overall, we don't see any significant downtrend on valuations due to COVID or due to kind of the current slack down. So it's a 20% reduction in public markets as a whole on multiples, maybe 25. Digital is a bit different. I think that's what we'll see in private markets. Anyway, the gap between private and public had increased significantly over the last year between valuations. We had a lot of deals which were private market was giving a value X and the public market was giving a value multiple. So the dispersion between private and public had increased significantly last year. So we think private will remain where it is. I think public is contracting.
Very helpful guidance, Gaurav. Of course, couldn't have been a better day than today with what's happening in the markets to discuss valuations. But I guess time will tell as to what happens. So let's move on as we move with our deal cycle, and let's talk a little bit about deal process. Vineet, coming to you, with the number of deals that the market is witnessing, what are the major challenges for private equity in getting M&A deals done, and how are they overcome from an Indian perspective? Can you share some thoughts?
So thank you, Haigreve, and good afternoon, everyone. I think there's been an interesting discussion so far in terms of, what Gaurav said and what Pankaj and Vibhor said. A few years ago, if you look at it, almost every deal was a one-on-one which went on for months. I think those days are long gone today, where sort of with the competition in the market and for every good asset, there are a number of PE funds vying for the same asset. PE funds really need to be nimble. I think the challenge is to sort of really understand the Indian market, the regulations around the sector, and sort of really ensure that you're on top of the game before you even get to the target. I think there was a time when people got to know the target and then started work. Now lawyers and bankers and even private equity fund guys are much before sort of they hit the target to have done their homework before they get in. The sort of exclusivity periods have shortened considerably from deals going on for months to sort of deals now happening. So that's a big thing. I think the other thing is that, while the market is sort of maturing in terms of negotiations and a turnaround of documents, we've also seen that a number of lawyers on both sides of the table are coming to a more standardized form. So it really helps in terms of, getting the deal times down, because most of the times, given the number of deals, most PE players want to sort of complete it and move on to the next one and concentrate on business rather than negotiating. So I think that has changed over the years a lot to sort of, smart deal making, people taking a call on more critical issues and material issues rather than run-of-the-mill every compliance issue that comes into the picture. The other important thing, I agree, which I've seen in deals is the promoter is now the center of the world. I think, a few years ago, founders were just sort of shot down. And you would have a number of negative covenants in trying to sort of tie them down. Today, you really see how PE funds are incentivizing promoters to really run deals, to be a part of it, and to grow the business for everyone. So I really believe that's an important aspect in terms of how people are looking at it. Also, the Indian market, in terms of regulations, while we take a step forward, we're also sort of dealing with a number of regulatory issues which come up time and again. A recent one being PN3, which sort of caused a lot of nervousness and stress around. So again, both PE funds, lawyers need to really sort of be on top in terms of what is happening, what is the market doing, have that access to the government to really understand how to play the game and sort of what's necessary and required. So that's an important aspect. The other one, if you would see, and most PE funds, US regulated, even sort of coming from Europe, ESG and D&I is becoming hugely important. So in terms of the green policy, diversity in terms of the portfolios that PE funds are looking at, I think that also becomes really important in terms of deal, and that's a challenge with sort of Indian companies which are at an early stage. I think some of these compliance issues really need to sort of be looked at and get sorted. And I think really a last point, Hegri, is you would also see diligences. I think my colleagues are going to sort of really touch base upon that. But a number of Indian companies early stage still do not concentrate on the compliance and regulatory aspects, which again makes it a catch-22 situation. While you want to get the deal done fast, you also want to ensure that you're on the right side of the law and the company is fully compliant in terms of the regulatory aspects. So I believe some of these things with the market maturing, hopefully sort of are being taken care of. But these are some of the challenges we really feel when we're doing deals that come into place. Thank you.
Thanks, Vineet. I'll reserve the discussion on diligence for a minute and come to Karthik on that. It's a very important subject. But before coming to that, I'd really ask, Vibhor, I'd ask you that how are you seeing the role of lawyers in deal making, and do you have any thoughts in terms of the balance between protecting clients' interests and getting a commercial deal done? How do you see that, and has that evolved over a period of time?
Thanks, I agree. No, I think given the pace at which all of us are working, this is more of an era of speed dating. So everybody has played its part. But if I may, I think it is paramount to protect clients' interest from a lawyer's perspective, and I think we do a fair job of that here. But there could be a lot more speed and efficiency that can be brought into that process. We lack standardization of documents. The start is never a standardized document. And while in private equity, some of us have gone through the multiple transactions, most promoters are doing their first transactions. And there things get slowed down. So as a system, I see often that very important business negotiations, including of price and structure, almost taking similar amounts of time as indemnities and warranties and reps. I mean, if I look outside in, the two probably don't need to be take equal amount of time. I'm yet to use the indemnities that have been negotiated over many nights. So there, I think all of us need to play our part better to make the broader system more efficient, is how I would say.
Thank you for those very frank comments, Vibhor. Let's move to a very important aspect, diligence. And quite often, this is one aspect of the deal where there is overemphasis, and sometimes we think not enough attention is paid to diligence. So, Karthik, can you throw some light on what are the most significant issues private equity faces in M&A deals doing due diligence in India, and how would you advise them to overcome some of these issues?
No, thanks, Raghav, and just great to listen to all the views on this panel. It's been very interesting. But before I take off on that one, before just one point on standardization, kind of hard, right? I mean, we get that a lot on these guys. Can't you just recycle the same documents? Having these issues being done to death, etc. But every deal is different sets of actors, different sets of objectives, different personalities. Kind of hard to make it all to a standardized product. Something like an NDA, maybe a cookie cutter loan document. You can live with that. But M&A, just with everyone's objectives and number of characters and emotions which come into play sometimes. I'd say kind of hard to even think right now. Maybe I'm not as tech savvy as Gaurav, so maybe I can't think beyond right now. But kind of hard to even think that we can really standardize every deal or deal documents or get it to a standard where maybe 70% of it is done and maybe 30% is left to the commercials or the principals to sort out at some point. But like I said, evolution is everything, and like God of like Heidi was mentioning, you're gonna get left behind. Hopefully we'll have a solution for that also down the road.
Sure. No,
Sorry,
I agree.
Gaurav, sorry, go ahead.
Nothing is easy in India. Is one way to look at it. And two, it's all about degrees, probably. So I was trying to allude that it could be to a slightly higher degree than what it is today. Gaurav,
Yeah, I was saying that we are seeing a situation where there are multiple parties in every deal. So instead of being a bilateral conversation between a promoter and a new private equity, which was the case till a few years back, now we have multiple sellers and multiple buyers, or multiple sellers at least. So I think the platformization, if I can use that word, of documentation intelligence is extremely critical to provide efficiency in the ecosystem. And different people start at different places. Even the seller actually becomes much more reasonable in his own mind if they see real data coming out of diligence. So I think one of the roles of diligence is to remove the parallax between the seller and the buyer. And the one can keep negotiating. I think so. Diligence, to my mind, both on the financial, accounting, tax, legal, every side, I think is very critical. And the depth of that from a commercial perspective is very critical. Commercial, legal, commercial, technical. So I really think that the role of diligence is going to increase significantly. You're going to have a lot of the deals are financed now. And I think the role of diligence, even that financing becomes very critical. A lot of the deals are insured now, become very critical, and so forth and so on. So I think as the ecosystem, more players are coming up, and each player may not have the facility or the time or the ability to do their own diligence. I think the onus on the vendors to do diligence, us as bankers on providing clarity to the last level of detail on what business we can underwrite and how we underwriting on metrics. And similarly for every other agency becomes even more important for the ecosystem. So I can't even actually, and a lot of deals are tailing around because there is just positive information to be. Different people take different decisions. I'll just rest it there, but I think the market needs to get deeper for all of us, including us, on diligence.
Right. I mean, on diligence, I think just over the years we've seen a lot of private equity folks just being increasingly mature. Things like non-stamping of documents, etc. It doesn't really bother folks anymore. As long as the high value business stuff is enforceable or the real key growth drivers are properly documented, I think people are willing to give a hall pass there. Things like RPTs, etc., related party transactions, I don't think people take a dim view of that anymore. As long as it can be adjusted for value, people don't see that as a diligence issue anymore. Even, labor law compliance gets a bit tricky because now because of ESG, etc., reputational issues, people want to take a correct step there. And I think most PE buyers are fairly straightforward. They want a clear remedial plan in motion. They want the contract labor sorted out. They want a clear portion maternity benefit policy, etc. So I think people are becoming more mature on those aspects as well. On some items, let's say provident fund, gratuity, where you need an actuarial valuation, where leaving encashment things get tricky. I don't think people again saying, look, this is a deal breaker. They're just looking for value adjustment in the larger M&A process. And I think the one piece where people have struggled a bit in India is on litigation and independent litigation searches. We still don't have a countrywide basis for searching any litigation databases. Lots of important tribunals still don't get picked up by the algorithms. Things like criminal complaints don't get picked up. You really have to rely on the target company to sort of feed you that information. But again, I see people being practical there. I mean, the W&I insurers are becoming really smart there. They're saying, look, if there's any litigation not picked up, not disclosed, we'll cover it off. So again, that's a good starting point to sort of, not allow the information gap to sort of affect the transaction. And look, like any other, any other business, there are going to be always sector-specific issues. More so in India, for example, emerging businesses. There's a lot of nascent regulation. There's a lot of flux in policy making. Tomorrow you invest in a payments business. Literally in 2 weeks, you're told that, look, by the way, this kind of business requires a payment aggregator license from the RBI. So have you factored that into your business plan? Have you factored the compliance into your business plan? Perhaps not. But that's obviously DD again, just to understand where the policy making is heading. What have other people done? What is the past precedent? Other aspects which tend to get sticky still are perhaps environmental DD. There's no W&I cover for that. And obviously, from a reputational perspective, there's taking no solution. Very difficult to quantify risk lost on environmental DD side. So again, it's just more seasoned deal makers and just a little bit more commercial maturity to sort of join the dots there. Sorry, Heidi, back to you.
No, that's really wise counsel and a lot of very good tips on the practical side and what to look at, what to concentrate on. Thank you for that. So as we move, keep moving, and we've seen market outlook. We've seen some of the PE investment issues in India. We've seen issues around diligence. Let's talk about another subject, exits. And coming to you, Pankaj, how do you think the market conditions will be for exits in 2022?
Well, I wish I was
very good. So let's talk about 22 now.
I wish I was an astrologer, Haigreve, right? But I think if you just look at the long-term trending, right? I think 7 to 10 years back, not just in India, but at the Asia level, right? We didn't have a lot of exit histories. You'll often get the question around, are you returning money to LPs in a profitable way, right? Are you making money? I think the industry has come a long way from that perspective. And so there's a history of returning and money and making money for LPs, so which I think is good news. I think, of course, the last year was fabulous for exits, right? I think there were a huge number of exits to the IPO markets. I think the industry as a whole returned 5x of what it had ever returned before in terms of capital. And we've seen that not just India, but I think globally. So I don't think that's a trend which India just bucks, but it's been a very strong year from exit perspective. So very difficult to see what will happen in the next year. But if you just took a longer term view, I think IPO market will continue to be a strong source of exit, right? Sponsor to sponsor has increasingly become more relevant. People are getting comfortable with that. We've seen that happen globally. We have seen that happen locally. So that will continue to happen. And even strategic exits, while that has been limited, I think if you choose and build the right asset, be the bridge of professionalizing, raising the compliance levels, etc., you will find strategics for the asset. So I think the longer term view is quite positive on that, and I think all three of those avenues remain relevant. Yeah.
Thank you. So I hope 2022 brings as much, if not more, cheer than 2021. So I think we are coming to the end of the panel, and we'll take some audience questions. But before that, I'd like to touch upon one topic, and that's regulations in India with you, Vibhor. Indian regulations have been dynamic. There have been a lot of changes. Vineet spoke briefly about PN3. What's your view? To what extent is regulatory scrutiny an issue for getting PE to do M&A deals in India?
Yeah, I think in India probably the media exaggerates both on the optimism and the skepticism side. So I would have a very balanced perspective on Indian regulators. I think they have done their job fairly well. Our regulators like the Reserve Bank of India and Security and Exchange Board of India, which is SEBI. If I compare them across markets, I think they have held things fairly steady. There are often, as a private equity investor, issues particularly with new regulations which are somewhat ambiguous, including the PN3 as and when it came. But if you look at the overall circumstances and context in which it came, there is only so much one could blame the authorities for it. Otherwise, I have been actually positively impressed with the pace of changes that the Indian regulators have brought, particularly with SEBI continually bringing changes with the change of markets across M&A, open offers, public floats, OFS. As an investor and a commercial investor, it is easy for me to always believe that these changes are slower and too little too late. But maybe as somebody who has been into the markets for 20 years, I have accepted that slower pace, and I'm pretty happy as long as the direction is fine. So that's at least how I feel about the regulations in the country.
I mean, if I had to add, that it's my favorite topic, right? So, but if I had to add to that, what you need is predictability, certainty of timelines, distinguishing between private equity and strategic capital, and regulations which allow you to be competitive in every scenario. I think we are making positive movement. We need to solve further across these four axes so that we continue to be competitive with predictable outcome in time-bound way.
Actually, I have a question for Gaurav on this one. Gaurav, when you go to a new prospect, let's say a large new PE fund which has never done India before, etc., how tough is it to sell regulatory risk to them, or how difficult is the market perception, or how easy is it? Just give us a little bit of insights there on that first-time investor.
So actually, it's become relatively very easy in terms of what I saw. And when everybody who doesn't only talk to us, talks to 5 other friends in the industry. And I think it's more than anything else. It's just ambiguity. I think ambiguity is very little right now about where you can invest, where you can't invest, what happens when you take out your money, what happens, what taxes you pay. We saw a huge issue on Mauritius, for 10 years in a row. That was the #1 issue on what tax indemnity, what not tax indemnity. Right from 2010 onwards, in the Vodafone time, that was the core issue in a transaction. That was a PhD subject by itself. So I think both general practices as well as law has become much less ambiguous. We see very little. Obviously, there are certain still areas of ambiguity around retail, but apart from that, we think that it is fairly simple around. I haven't seen actually a challenge where people are talking about. The people do talk about exit possibilities. People do talk about valuations and valuation in India compared to other markets, etc. But regulatory issues very little. So we have got now some 10 new investors last year into India. Never done India before, and it's easy.
Super.
I mean, that's really great to hear this. I mean, from somebody, all three of you, from what we hear, the landscape has changed. Of course, we need certainty, we need predictability, but from where we were and where we are, there is a huge positive change there, which is fantastic. Great for the country and for investors. So let's take we have some very interesting audience questions, lots of them. I don't think we'll be able to deal with all of them, but I'll take some here and ask you all to address them, and then others we can respond to the audience on email. So we have one question, and maybe Gaurav, you can take this. It relates to exit and market. This is from Dhruv Chopra at GE. And his question is that it seems that IPOs of companies where PE have invested heavily have not been accepted by the people with much enthusiasm, and stocks have gone down post-listing. Are you able to throw some light on what areas PE should focus more in such cases where they're looking at IPO exits and considering valuation at the time of IPO exit?
So I think the subject is, in my mind.
The way I can understand is it's exit through IPO, and what's your experience generally PE exit through IPO? I guess the question is it well priced, or PE should perhaps devote a little bit more time in seeing that there are returns to investors or not? I mean, that's the question really. Exit through IPO.
I have a fundamental view on valuations as a whole, right? As an entrepreneur, as a business leader, as a CEO, you can focus on creating value in the business, and that's what you drive business toward: your fundamental value, your culture, your return economics, your growth, your sustainability, your market share, your competitive advantage, so forth and so on. Over the market prices you. Okay, different markets price you differently. Private markets price you differently. Strategic markets may price you differently. Public markets may price you differently, and markets actually change. Sometimes they change sharp, sometimes they change easy. We have seen the private market valuations going up significantly over the last 5 years for the same company. The the EBITDA multiples, the P multiples, the gross margin multiples, all gone up for the same consumer company 3 years back to today. It's just a fundamental shift on value. So I think public markets are more visible. They actually react sharper to a lot of events that happen across the board, not only this. So I would actually not worry about too much. I think at any point in time, at this point in time, this is the price in the market. Now, as a seller, either you can choose to take that or not choose to take that and go private. So I'm actually less, judgmental on the valuation that things happened at. There is and market find a way to equilibriumize very quickly. I have actually no concerns on valuation. I'm more concerned about quality of companies being taken public, quality of companies being sold in the private markets. That's my number one concern, and that's all will remain my concern. Now you'll see, good companies coming back now. Who knows what the right value was? Valuation is a function of what the market is willing to pay. So I'll leave it there.
Very balanced, Gaurav. Thank you. Let's take the next question, and this comes from Karora at Secretariat International. Maybe for Karthik, it's a little bit of a legal issue. PE in India has been involved in a number of disputes arising out of guaranteed IRR related exit mechanisms. How has PE adapted to some of these hurdles while structuring their investments?
I think people have been. I think they've sort of come around the hedge fund mentality to say that, look, not every deal has to be a guaranteed IRR. We're going to leave something on the table. We'll have to trust the market to get us the returns we want. I think the other one is, obviously there are other structures available which people have explored to get the guaranteed IRR. One is a co-investment through an AIF, because the AIF is not subject to any restrictions on guaranteed IRR. The other piece is they're all very open to the idea of using FVCIs now. The FVCI is not subject to a guaranteed IRR. So I think the between and third one, of course, is by sort of tinkering around with the debt rules, doing a non-convertible debt deal, which is sort of linked to market-linked equity, but at the same time has a guaranteed IRR, is a third option folks have looked at. So look, there are enough arrows in the quiver to sort of speak of, to sort of not get around, but to coexist with the guaranteed IRR rule. But I don't think that's so much of a hot button topic with investors anymore. I think I don't see that as a top 5 or top 6 issue at all for any investors now looking in India to say that, look, guys, if IPO doesn't happen or a trade sale doesn't happen in 5 or 6 years, where's my guaranteed IRR? Where's my exit? I think people are sort of more open to find an equilibrium with the market at that point of time. They're not really looking to it's very similar to the US, right? I mean, you won't see a Silicon Valley deal where there's going to be a guaranteed IRR on the founder. So I mean, why should it be any different here?
Very interesting, good perspective. Thank you, Karthik. We have another question from Mohammed, and maybe Pankaj, I might address this to you. Pankaj would like to have your views and insight on SPAC framework, and SPACs have been quite successful for exits outside of India. Do you think the SPAC framework should come to India for PE exits? What's your general feeling around it?
Yeah, so I think, on SPACs, I'd say, while there has been, of course, a lot of news around it and a lot of capital has been raised, it's not an immediate liquidity or monetization event, right? It's a step towards liquidity or monetization for private equity. So to that extent, that's a misconception, right, which most folks have. I would say the simple answer is any form of additional revenue is always welcome in India, right? It allows you to deepen the market and provide you with more options. So that's my kind of limited view on this one.
Thank you. Thanks for that input. We have another question on ESG influence, and maybe Vibhor, if I might address this to you. How does ESG influence your decision in doing M&A deals in India? And do you think that this is going to have a deeper impact in the future for investments?
Sure. Thanks, Hagreev. I've been surprised at how fast and how important ESG has become. So I would say that it is already playing a deep impact in the present times, I agree. We have limited partners who have a very, very high bar on ESG, and in particular, investments in particular sectors, we have to clear the ESG bar of our LPs. So it's not even a matter of choice, and frankly, at times the discretion is lying with the LPs themselves. And given that and how sensitive it is for the LPs, which are obviously very big funders for all of us, the bar of the GP itself has gone much higher. So even and now the GPs are willing to leave a good commercial transaction on the table if it is not beating the bar. Now that is something I hadn't envisaged that it will happen so soon. It always appeared like something in future, maybe 5 years down the line, but it is here. So that's how important it is before we are looking at a potential chemical opportunity or a bolt-on for some of the portfolio companies. The first thing we are trying to do is to check if it meets the ESG bar. Everything else comes later.
To add to that, the shift which we've had is on ESG, the mindset shift which we've had is from compliance to LP requirement, and I think the next stage is going to be a value creation lever, which can it add or enhance your overall value of the company, and that's the shift at least I feel you'll see over the next 5-10 years on ESG.
Thank you. I think very, very interesting again how fast market is moving and how much emphasis there is. Very interesting. Thank you. We have a question on spin-offs and carve-outs, and who better than Pankaj to answer this, who I think is set the innovation on doing deals with carve-outs and spin-offs. So the question is that are spin-offs and carve-outs likely to be the model for PE investment, given how cash flow pressures are there in companies? And in some sectors, do you think that this is going to be the area of activity?
Yeah, so I think I agree rightly. So you've seen that activity increase over the last few years. Private equity will focus more on it because it's complex, allows you to create a differential angle and therefore create value. And I think you will hopefully see more of it, not just because of cash flow pressures, but also because people realize that businesses are non-core and you want to get to what is core for you, and therefore businesses will come out of it, right? So I think both from a supply side, hopefully you'll see more. And from a demand side, because you realize that it's complex, it's more hard work, it hopefully helps you meet your return threshold. So clearly an interesting area to watch out for. Yeah.
Thank you. One question maybe I'll address to one of the lawyers, and this is a question as to whether in PE investing and deal making, have you seen Competition Commission of India issues coming up as big uncertainties in PE making M&A transactions or doing M&A transactions in India? And this is from Shruti Swaika, question from her.
I mean, I would think actually, India is probably one of the more charitable jurisdictions from a PE perspective in terms of antitrust interference. I think unless you really have overlapping horizontal business, I don't think they've really come in the way of any large PE deal in India. I think the CCI's track record speaks for itself, and I think even in terms of timing, I think the CCI, I think the track record is impeccable. The 30-day turnaround times for complex, large PE filings, where PE is the M&A acquirer, I think that's really unparalleled, and I think they're doing a great job. And I think for PE, I think they've really enabled things rather than blocked anything in India. So and we haven't really seen any crazy orders here from the CCI where you've got to do a whole separate, or you've got to carve out businesses, or the overlap is so crazy for them that they've sort of come in the way of the transaction. So I think the track record with competition and PE in India it's been pretty good so far, and I don't see anything really on the horizon which leads me to believe that there's reason to worry about. Heidi, what about you? What do you think about that?
No, I would quite agree with you. I would quite agree with you. I know that for a lot of financial sponsors, this whole rule on horizontal and vertical and where there are overlaps when they have existing investments is causing some concern. But I guess the regulator looks at it from one perspective, where if there are overlaps, you do need to do a filing and that needs to be considered. So I think that's an area where maybe some more objectivity will come as the market matures and more sort of financial sponsor investment we see. I think that's one area I'm seeing with the Competition Commission. But other than that, I quite agree that there's a good balance, I should say, and we haven't really seen from a PE M&A perspective too many hurdles from a CCI perspective. So I think we're coming to the end. One final question from the audience, and Gaurav, for you, can you throw some light on which sectors you expect PE to be more attractive to PE for M&A in 2022? What's your foresight for 2022 PE and M&A?
Attractive to PE for investing, M&A, I'm not clear.
M&A sectors, which are the hot sectors for PE M&A for 2022?
Well, PE buyouts, you mean? So I would say, if you say PE buyouts, one of the sectors which is quite ignored and I think should become very interesting is manufacturing. I would say, I think there will be a lot of opportunities there. A sector which has actually taken less attention last year, but I think will participate significantly is financial services, especially specialized financial services. I would say technology will not be a buyout market, it will remain a growth market. IT services continues to remain very hot for PE buyouts, given the growth rates and digitalization and transformation on IT services. I think tech services, enterprise tech services remains very hot. Healthcare and pharma board delivery remain very significantly key. Everybody wants to buy and consumer business services, there aren't enough assets available. I think, so that's where I will call it out, yeah.
Interesting. Any thoughts on any other sectors, Pankaj, Vibhor, you think, other than what Gaurav has mentioned?
I think Gaurav has covered it all. I would echo Gaurav's point on manufacturing, right? It's been a long ignored sector, and some of the macro tailwinds that we're seeing play out will enable a lot more activity in that one.
Actually, very interesting and intriguing that, where at least from the entrepreneur community, I've been constantly hearing over the last decade how to get out of manufacturing. And a lot of entrepreneurs, are talking that language. And now you have a full circle where PE is exactly thinking that we must get into manufacturing. And
I think that's a great point, because where one emotional energy stops, the other emotional energy begins, and that's absolutely the good cycle. We can do a lot with that sector. We need capital investment in that sector. I think I'm actually keen, and I think more deals will happen. Our industrial pipeline is the hottest ever, so I think I know what deals are going to happen.
Fantastic. I think that is really good for the country, the economy, for employment. And I think while we've been looking at and investing in a services economy, of course, agriculture is very important for us. I don't think not focusing on manufacturing would be wise, and very good to see the PE interest in manufacturing. Very heartening. So that really brings us to an end to our session. And before we end, Vineet, can I ask you to give us 3 key takeaways from today's webinar that you think the audience should focus on while doing PE M&A deals in India?
So I think I agree. It was a very good discussion, with all 3, Pankaj, sort of Vibhor and Gaurav, coming up with, points which are interesting. I think one thing really for a big takeaway for me is that I'm definitely going to be busy for the foreseeable future. And we see the PE outlook being really robust for not just 2022, but I think the coming years as well. I think another heartening discussion, which came out, which I think both Vibhor and Pankaj sort of alluded to, was that while there are regulatory concerns, it's not as if it's a huge issue. I think Gaurav mentioned that even while he was speaking to sort of new PEs coming into India, I think that doesn't form a big part of the discussion. So it's good to know that a lot of players are not looking at Indian regulation in a negative way, but I think more to the extent that overall the world is moving to a more regulated environment. So to that extent, we need to work around some of those regulations. India is also sort of really keeping pace with the regulatory environment across the world, be it on the competition side, be it on some of the other sectoral regulations. So that's the second takeaway, that whoever comes in doesn't need to necessarily worry about the regulations in India, but need to sort of really understand and play with them. And I think the third really agree is that while there is a lot of dry powder coming into India, there is competition. But again, India being a consumption economy, I think there is room for everyone. So again, with the co-invest deals, with the number of good targets coming in and the sectors which are open, I think there is a lot of room to play, and the outlook is really robust and good looking, which sort of really gives me some cheer as a lawyer as well.
Thank you, Vinny. That was very insightful. One question, you mentioned regulatory and that being easy. I just want to ask Pankaj and Vibhor if they've had any experience on the regulatory side investing in any other emerging market, and on a comparative basis, have they found dealing with the regulatory environment investing in India versus in another emerging market very different or about the same?
I know in some of the Southeastern Asian markets, I agree, the engagement is probably a little more difficult. The approachability of the regulators and the via intermediaries or directly is pretty good. Sometimes it gets balanced by the ambiguity of regulations in those markets, at particularly the developed ones, is lower. But you can work your way around here, particularly in terms of engagement with the regulators, which often is helpful to understand the mindset of the regulators of what would be possible and what would not be possible.
I think Vibhor has covered it. I don't have anything incrementally to add to that.
No, thank you. Thanks for that. So before closing, I'd like each one of you to respond to the poll slide on your screen. If we can have the poll slide, and to provide your feedback on today's webinar. We take this very seriously as a part of our continuous improvement program. Finally, I would like to thank each one of our guests for sharing the experience and expertise with us today. Gaurav, Pankaj, and Vibhor, thank you so much. We really understand the demand on your time, and thank you for spending this hour and a half with us. Without you, this webinar would not have been possible. You each did an outstanding job, and we are very much indebted to you. To our audience, I hope you found the webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you. After the webinar, we will send you a copy of today's presentation material, summary notes, and a link to the recording. We will also separately send you a request for your feedback on the webinar. Please do take time to send us your feedback, comments, criticism, and even compliments. The form takes less than a minute to complete. Please do not hesitate to contact us regarding any other matters in relation to the webinar. Our contact information is on the contact slide at the end of the webinar. Thank you for your attendance, and we look forward to being of service in future webinars. Thank you.
Thank you, everyone.
Thanks, everybody.
Thanks, everyone.
Good afternoon. Thank you. Thank you, everyone. Bye-bye.